thank you very much for being here, and we're looking forward to your presentation. The floor is yours.
Thank you, Linda. I just want to add my thanks to everyone for taking time out for this. We're looking forward to your feedback on this new project. My co-authors here are Luboš Pastor and Rob Stambaugh, and this paper really is about the rise of ESG investing. It's a great opportunity to be able to present this paper to this particular group of people, since you're so interested in sustainability. Of course, I wish I were in Zurich right now. It must be beautiful there right now. At the same time, I'm glad we're doing this seminar sustainably over Zoom. So I don't have to tell this group that ESG investing has become a very big deal. By one measure, if you look at professionally managed assets in the United States today, 1 out of every $3 is following some form of sustainable investing strategy. The main question that we're after in this paper is, should we expect superior returns from sustainable investments? Well, if you ask investors that question, they often say yes. I've listed 3 surveys here where they've asked investors, why do you do ESG investing? And what comes in either first place or second place, depending on the survey, is they do it in order to get higher returns. That's their motive, their stated motive for doing this. Another question that's interesting in the BNP Paribas survey, they asked, do you expect your ESG investments to outperform? 60% said yes, they expect them to outperform. If you ask asset managers, they also usually say yes. Here's a quote from Larry Fink of BlackRock. He said, integrating sustainability can help investors build more resilient portfolios and achieve better long-term risk-adjusted returns. State Street just puts it more baldly. They say ESG is a source of alpha, and they mean positive alpha. If you look at the past performance of certain ESG investing strategies there, well, the answer also seemingly is yes. And I've listed a few papers that show, sure enough, certain ESG strategies have performed well. In this paper, I've realized that I'm not even sharing my screen, so I guess I should do that, right? Let's see, am I now sharing? Can you see my slides?
Yeah, we can see your slides.
Okay, thanks, Linda. Sorry about that. So in this paper, to this question, should we expect superior returns? Our answer is no. And it's not that we're climate deniers, it's far from that. Really, we have a theory reason and an empirical reason for answering this question, no. So the theory reason goes back to a paper that we wrote. In that paper, it's called Sustainable Investing in Equilibrium. In that paper, we're trying to understand how will ESG investing affect asset prices. And what our theory predicts is that sustainable investments have lower expected returns for 2 reasons. First of all, ESG investors, they like holding sustainable investments. That pushes up the price of sustainable investments. Equivalently, it pushes down their expected returns. And of course, the opposite is true too. ESG investors don't like holding unsustainable investments. That pushes up the expected return of unsustainable investments. That's the first reason. That's really about tastes that investors have. The second reason is about risk. We argue that sustainable investments are a hedge against climate risk. Sustainable investments perform well when we get bad news about climate change. That makes them safer. So sustainable investments being less risky, well, they can offer lower expected returns. Now, you might say, well, green companies, sustainable companies, they're going to have very high profits in the future. Well, that may be true, but if those profits are already expected today, an efficient market will already price in those effects from expected future profits. So expected future profits are completely irrelevant for expected asset returns. So that's the theory reason. This paper focuses on evidence. In this paper, we show that the past superior performance of sustainable investments was unexpected. Our argument here is that one thing that was very special about the past 8 years is that concerns about climate change increased a lot, and they increased more than was anticipated. That has two effects. First, it led investor demand for sustainable investments, sustainable financial assets to go up. That directly pushes up the price of greener assets. And the second channel is more about customers. We think that as people became more concerned about the climate, customer demand for sustainable goods and services went up. And conversely, customers' demand for dirty or unsustainable companies' goods went down. And that also pushed up the price of these sustainable investments. I mean, so the broader kind of message or point of the paper is that the past performance of sustainable investments is not indicative of their expected future performance. Let me provide a motivating example before I kind of summarize the paper's main results. This example is about German twin bonds. So the German government has run kind of a useful experiment for us. The German government has been issuing green bonds since 2020. For example, their first issue was in September of 2020. They issued a 10-year zero coupon bond in the amount of 6.5 billion euros. And what's very useful to us as researchers is that each of these green bonds has a conventional twin bond, okay? So it's a twin bond. It has exactly the same issuer. They're both backed by the German government. These two bonds, they have exactly the same maturity date, coupon rate, and coupon payment dates. It's just one is labeled green, the other is not. And this is useful because it lets us kind of identify what is the effect of greenness as opposed to cash flows. What is the effect of greenness on expected returns and realized returns? What's also really nice about the bond setting as opposed to stocks, the nice thing about bonds is that we have a good measure of expected returns on bonds. Namely, the yield to maturity on these German bonds is a good measure of expected return, at least for a buy and hold investor. So let me show you the data on one of these pairs of twin bonds. So what I'm plotting here is the yield to maturity of the green bond and its twin for one of these pairs. And what you'll notice right off the bat is that the green bond always had the lower yield to maturity. That indicates the green bond always had a lower expected return. And that's consistent with our theory. It's consistent with investors accepting a lower return for holding a greener asset. Maybe they might be accepting a lower return just because they get a warm glow utility. They get a good feeling from holding an asset that's aligned with their environmental values. This gap in yields between the green bond and its twin is called the greenium. And I'm going to plot that greenium on this slide. So again, this is the yield spread between those bonds, the greenium over time. If you look at the very first data point here, when the green bond was first issued, that greenium was slightly negative. What that means is the green bond was expected to underperform the twin, had the lower expected return. So we expected it to underperform. Did it underperform? The answer is no. I'm showing that in the bottom panel where I'm showing the realized return on the green bond relative to the twin. So this is the return on a long short portfolio where you buy the green bond, short the twin. And what this blue line tells you is that the green bond outperformed, contrary to expectations. Now, we look at the data, we see the green bond outperformed. Should that lead us to expect further outperformance of the green bond? And the answer is demonstrably no, right? We can see that in the top panel. What we see is that the greenium during this time period deepened, so that by the very end of this period, the greenium was actually at its lowest point. That means at the end of the sample, we especially expected the green bond to underperform in the future. In fact, the outperformance of the green bond in this short period came entirely at the expense of its expected future performance. So it's an example of how a shift in expected return led to outperformance of a green asset, but that should not lead us to expect further outperformance in the future. We like this example because we think it's simple, it's clean, it shows that the past performance of a green asset is not necessarily a good indicator of its future performance. But again, this is just a motivating case example. Most of our results in the paper are about stocks. So first of all, we show that green stocks outperformed brown stocks in the 2010s. By green stock, what I mean is the stock of an environmentally friendly company. So in this paper, we're focusing on the E part of ESG. It's a paper about environment. A brown stock is the stock of an environmentally unfriendly. So you can think of brown as being like a coal company. You can think of green as being like an electric car company, all right? So specifically, we create a green minus brown valuated stock portfolio with US stocks. And we showed that its average return was huge. It was 65 basis points per month over this period, highly statistically significant. We also study a theoretically motivated green factor. You can think of this green factor as being long green assets, short the brown stocks, where we're weighting these stocks by their greenness, by their E characteristic, not their market cap. And similarly, we showed that green factor, it performed very well over this period. So green outperformed. But our main result is this one. We showed that the green factor's outperformance was unexpected. And it was due to unanticipated increases in concerns about climate change. We make that point by showing that the outperformance of green stocks during this period vanishes if we counterfactually set climate concern shocks to zero. So we're saying if we had not become more concerned about climate change, green assets would not have outperformed during this period of time. So basically what we're saying is that the realized return on green assets was bigger than their expected return. I would say, there are a lot of papers out there in the literature about the performance of ESG strategies. What sets our paper apart from the literature is that we're really focusing in on this wedge between realized returns and expected returns. Basically, we wrote this paper because we noticed a lot of sloppy thinking about the difference between a realized return and an expected return. What is the wedge between the two? Well, the wedge, of course, is unexpected shocks. And we're arguing that a key source of unexpected shocks in this period was the increasing concerns about climate change. As I'll explain at the end of the talk, this result has important implications, not just for ESG investors, it also has important implications for firms' costs of capital. It also has important implications for how we do empirical asset pricing in general. We also find that the green factor's outperformance explains the historic underperformance of value stocks versus growth stocks in the 2010s. This was the worst decade on record for a value minus growth investing strategy, and people have been kind of puzzling over why that happened. Our explanation is that value stocks tend to be brown. An example would be a coal company, clearly a brown stock, but it also tends to be a value stock. Whereas growth stocks tend to be green. An example there would be Tesla, right? Tesla is clearly a growth stock, and it's also an environmentally friendly company. And finally, we show the green factor reacts to climate concern shocks with a delay. So we're finding that small stocks in particular are reacting or are underreacting to climate news. So that's the summary of our results. Let me jump into the details. First, let me tell you how we measure greenness in this paper. We use data from the MSCI ESG ratings. I'm guessing a lot of people here have also used these data. We're using MSCI because it seems to be becoming the kind of industry standard for ESG scores. So this story may interest people here. I was at a conference recently and I ran into this guy, Andrew Ng, who does a lot of investing work for BlackRock. And he's doing a lot of BlackRock's research on ESG. And I said, of all the different ESG score providers out there, like what's the industry standard? And he says MSCI ESG ratings are the industry standard right now, at least among practitioners. So for firm I, we want to measure its greenness in month T+1. And here's the formula we use to do that. Let me first of all define the components here, starting with E score. This is the MSCI variable called environmental pillar score. It measures a company's resilience to long-term environmental risks. It is a weighted average of scores across 13 environmental specific issues. The other variable here is E-weight. That's the MSCI variable environmental pillar weight. It's a number between 0 and 100. It's defined as the importance of environment relative to social and governance issues in this company's industry. All right, so those are the components. So looking at the formula, 10 minus E score, that's how far away this company is from a perfect score of 10. So that's basically how badly you score on environment. E-weight is how big are environmental impacts for your firm. The product of those two is basically how brown the company is. We put a minus sign in front of it to convert it from brownness to greenness. And it turns out to be important to interact the variables in these ways. MSCI interacts them in a similar way. It's important. Let me give you an example why. We like the example of ExxonMobil versus Best Buy, the electronics retailer. If you look at their environmental scores alone, well, they're almost identical. If you only looked at the environmental scores, you'd get the, we would argue, incorrect impression that these companies are equally green. But notice their environmental weights. They're very different. ExxonMobil has a much bigger weight. That just reflects that oil and gas companies have bigger environmental impacts than consumer retail companies. Once you run the variables through our formula, you get these numbers, which reflect that ExxonMobil is much less green than Best Buy, which we think makes sense. Next, we use company I's greenness relative to overall market greenness. We do that because our theory tells us to do that. So the key variable in our analysis is going to be this little g variable. That's defined as the company's greenness minus the average greenness in the market at that point in time. Let me show you some interesting summary stats here. This is kind of a validation exercise. We've ranked industries by their average greenness at the end of our sample. Let me start down at the bottom. These are the least green industries. And it's kind of what you would expect, right? It's chemical companies, oil and gas, steel, metals and mining, non-precious. That would include coal, the coal companies, paper and forest. So the companies cutting down our forests, marine transport, a notoriously pollutive industry. So it's reassuring that the industries we suspect are very brown. They show up as being brown in this ranking. What about the green industry?
Quick,
well, that's a little, yeah, please.
Sorry, quick clarifying question. So in the beginning, you've also put a lot of emphasis on climate, and the key thing would there be probably carbon emissions that you would look at in terms of green and brown. Now here you have E, so that would also include, I suppose, water, for example. So I'm just curious why, why use E and not just a climate kind of friendliness score right away?
Yeah, we do it because if you look at the MSCI subcomponents, they're mostly about climate. In fact, for almost every single component, you can make the argument that there's a relation to climate change. At the same time, we're totally sympathetic to your point, and one thing we plan on doing is to zero in on the MSCI subcomponents that are definitely about climate change and nothing else. Like throw out water use, for example, and we're going to see how our results change. It's something we plan on looking at. So yeah, good comment.
I see. Thank you.
Yeah. So what are the green industries? That's less expected, I would say. Good news for finance, at least. It's a lot of finance. It's banks, it's consumer finance, professional services, but then you've got telecom and healthcare. And we suspect these industries are ranked as green because they have low E weights, right? These are industries with low direct environmental impacts. All right, we start our analysis in November of 2012. And the reason is MSCI coverage jumps at that date. After that date, we're going to be working with this sample that includes more than 2,000 stocks at each point in time. And these are US, we're only using data on US stocks here. All right, so let's look at the returns on green versus brown stocks. We create two valuated portfolios. We create a green portfolio by taking the stocks in the very top tercile of greenness. And the brown portfolio, those are stocks in the bottom tercile of greenness. Here I'm plotting the portfolio's cumulative returns. What you see is that over this roughly 8-year period, the green stocks massively outperformed the brown stocks. They outperformed by, I think it's 174 percentage points over this 8-year period. It's pretty striking. You see it in the picture, but you also see it if you just run some regressions. So here's some regressions. On the left-hand side, we have the return on the green minus brown portfolio. The first column just shows you the average return on that portfolio. The average return was 65 basis points per month with a T-stat above 3, so highly significant outperformance. In the remaining columns, we throw kind of traditional asset pricing factors on the right-hand side of the regression. And what we find is that the alpha of this green minus portfolio remains large in magnitude and highly statistically significant. So for example, in column 2, we run a CAPM style regression and find, the alpha actually gets bigger. In column 3, we include the Fama-French 3 factors, including value versus growth. Again, it survives. We include momentum in column 4. We include a liquidity factor. Column 5, we include the Fama-French 5 factors. No matter what we throw at this thing, what we're finding is green minus brown, we're finding green stocks outperformed by a lot in this period. This green minus brown portfolio, though, it's kind of ad hoc. It doesn't have a great theory motivation. What we want to do next is look at a green factor that is theoretically motivated. Before I show it to you, I want to give you the theory background for this, which comes from our previous paper, which is coming out soon in the JFE. So this is an asset pricing theory paper, and I want to summarize the assumptions we make in this one picture. So in our theory, we have heterogeneous firms. Some firms are green, some firms are brown, and then you've got spectrum in between. A green firm is one that has positive social externalities. So if a company is green, if it has a positive G characteristic. Brown companies are companies that have negative externalities on society. So think of those as having negative Gs. We also have, a variety of investors out there. And each investor has a preference parameter, DI, that summarizes how much they care about ESG. Some investors care a lot. They have positive DIs. If you care a lot about ESG, you get extra utility from holding green assets in your portfolio. You get like a warm glow, essentially. You would get disutility though from holding brown assets in your portfolio. You might have some investors whose D is 0, so they don't care at all about ESG, and so they're kind of indifferent about the ESG characteristics of their holdings. The average value of D has important asset pricing implications, which I'll summarize here. So these are the model predictions. We predict greener assets have lower expected returns. They also have lower CAPM alphas. And the reason, again, is what I mentioned before. It's because green, if you're an ESG investor, you like holding green assets. That pushes up their price. That pushes down their expected return. We also find, though, that these greener assets, they can have higher realized returns and higher realized CAPM alphas when tastes are shifting unexpectedly either toward green assets or toward green products and services. We introduce an ESG factor, F, that's capturing these unexpected shifts in customer tastes or investor tastes for green assets or green products. This ESG factor, it's long green assets, it's short brown assets, and the theory tells us to weight these assets by their greenness, as opposed to weighting by market cap. And the theory tells us that this ESG factor, it has an expected return that's negative. That's just another way of saying we expect green assets to underperform. The magnitude of that expected return depends on D bar, that level of taste, that average level of taste for ESG characteristics that investors have. The theory also tells us that the ESG factor, together with the market, prices assets in a two-factor asset pricing model. That means if you were to regress asset returns on the market return and this ESG factor, you should find no intercept. You should find no alpha with respect to this two-factor model. So that's the theory background. So we take the theory to the data in this new paper of ours. So what we do first is we construct a green factor. This green factor is playing the role of the ESG factor F from that theory. The theory tells us to construct the factor this way. So what are these variables? RET, that's a vector of stocks, market adjusted excess returns in month T. We're multiplying them by G, that's a vector of stocks greenness, lagged. So what that means basically is that this ESG factor, it's the excess return on a portfolio of market hedged stock positions where green stocks are getting long positions, brown stocks are getting short positions, and these positions are proportional to how green the assets are. Now, this factor, it's kind of only defined up to a scale parameter, so we have to choose that scale. We choose the scale to make the factor's monthly volatility the same as that value-weighted green minus brown return that I showed you earlier. So that's how we construct this factor. Here's how it performed. The solid line shows the cumulative return on the green factor. And for comparison, the dashed line is that green minus brown value-weighted return. And the returns are strikingly similar, like way more similar than we would have expected. Because of that similarity, going forward, we're just going to look at the green factor. That green factor, basically, it's playing two roles in this project. It's a simple way to summarize green versus brown performance, but it's also a theoretically motivated asset pricing factor. So what we do next is we ask, well, can this new pricing factor help us understand other assets returns? I'm going to go through this fast because it's not so much about sustainability. So first off, we ask, can this factor help us understand the returns of value versus growth stocks? Value versus growth had a really bad decade, had a really negative CAPM alpha. But once we throw in that green factor, we can explain about 80% of that performance. And we explain it because value stocks tend to look like brown stocks. Growth stocks tend to look like green stocks. And then we look at the performance of momentum trading strategies. Momentum performed really well in this decade until you throw in the green factor. And the green factor can explain away basically all of this outperformance of momentum over this period. But I want to go to the more sustainable part of this paper, which is about how can we explain the green factor's performance over this period? So to review, what I already showed you is that the green factor's realized return was very positive over this 8-year period, but its expected return is negative, at least according to our theory paper. How can we reconcile these? Well, our theory tells us how to reconcile them. According to our theory, this green factor's realized return can be positive when period T has unanticipated, either increases in demands for green firms products and green firms stocks, or conversely, if there were decreases in demand for brown firms products or brown firm stocks. So basically what we're saying is, if during this period, people unexpectedly said, hey, let's disinvest from coal stocks, well, that would be bad news for coal stock returns. Or if they unexpectedly said, let's stop buying coal, that would also be bad news for coal stock returns. That's all we're saying. So what we're asking, so there are, of course, a bunch of sources you could imagine for these demand shifts for green versus brown stocks or products. We're going to focus on one particular demand shift that seems plausible in first order, which is demand shifts that resulted from changing concerns about climate change. We think one thing that was really special about these last 8 years is that there was this huge awakening about the concerns of climate change, and that shifted demand. So we're asking, can this factor's past positive performance be explained by increases in concerns about climate change?
Look,
to study that, we need to measure climate concerns.
Quick question.
We're going to measure that using...
Can you hear me? Sorry, quick question. On unanticipated. So unanticipated on average, I suppose, that because I would imagine some of the ESG investors would say, that's exactly what we anticipated, and now we're reaping the return.
Yeah, absolutely. Take Al Gore. Like, Al Gore said, look, I anticipated all this increase in concern about greenness. So it would not be unanticipated from his point of view. We're saying it's unanticipated from the average investor's point of view. Yeah, great question. Okay. I'm gonna write that down. Okay, so we're measuring this using the Media Climate Change Concerns Index. Really cool index. I recommend it to people. It was created by these authors, Ardia et al. It's aggregating data from 8 major US newspapers. The index captures the number of climate news stories every single day, as well as the stories' negativity and focus on risk as measured by textual analysis. So we're going to measure the level of concern about climate change using this variable CT. It depends on how much scary climate news was there in month T, but it also depends on how much news there was last month and the months before that. Basically, we're assuming that memory of climate news decays gradually over time. This parameter rho is just capturing how long these climate news stories persist in people's memory. We set the half-life of climate news to 1 year, so we're going to use rho equal 0.94. In red here, I've plotted the level of concern about climate change, and to no one's surprise, it went up a lot, but it didn't go up monotonically. I've overimposed the cumulative green factor return, and when you eyeball it, they kind of move together. It's looking like when we get more concerned about climate, green stocks outperform brown stocks. So bad news about climate is good news for greener stocks. We want to study that more carefully by running a regression. we're running a regression of green factor returns on the change, the month-over-month change in the level of climate concerns. We included its change in the same month and the previous month. We get no significant relation to climate news from the contemporaneous month. But the previous month's change comes in highly significantly. So we're finding a big positive coefficient. That means when we get really bad news about climate last month, then this month, green stocks tend to outperform brown stocks. Directionally, we think that makes a lot of sense. When people suddenly become more concerned about climate change, what are they going to do? Well, they're going to start buying more products from greener firms, possibly because of government regulation that pushes them to buy greener products or pushes them to stop buying things like coal. And the other thing is, when we become more concerned about climate change, well, that gives birth to ESG investors who start to demand greener stocks in their portfolio. And that, that would also help green stock returns. And it comes in with a big T stack.
May I ask a question here?
Yeah, sure. Ann.
Can you hear me? Thank you.
Yeah.
Yeah. So I'm wondering, are you maybe also a bit concerned that just seeing those big returns on ESG portfolios, that those returns themselves also make people interested in ESG investing? So kind of a bit of a reverse causality that, yeah, because I see this talking about ESG stocks outperforming brown stocks, I get interested in the cause, and yeah, this leads to further increases in the returns.
That's kind of an interesting idea. I had not thought of before. It's testable. We would want to throw lagged green factor returns into the regression and see if they enter significantly. I kind of agree with your overall story, which is that, geez, like these investments outperformed a lot. And that created interest in ESG investing. We're going to try to capture that, but through a different way that actually I'm going to explain on this slide. So you'll tell me if this is capturing a similar story.
Okay, thanks.
We think that these climate concerns drove a lot of these demand shocks for green versus brown assets, but there were other possible drivers. Let me start with the second one, which really gets to Ann's story. So we want to proxy directly for investors' demand for green assets. And we do that by measuring capital flows into sustainable mutual funds and sustainable ETFs over this period as measured by Morningstar. We also want, that's basically our investor channel. We also want to look at the customer channel by measuring proxies for demand, customer demand for greener products. And our thinking is that if customers suddenly demand green products, that should show up in the stock returns, in the earnings news of green versus brown companies. And we measure that in two ways. The first is with abnormal stock returns around earnings news events. And the second way is by looking at changes in analyst forecasts of long-run earnings growth. When we put these are kind of green minus brown cash flow measures and then ESG flows. When we add them to the model, they come in with the expected positive sign, but they don't come in with statistical significance. They do have some pretty strong economic significance, which I'll show you in a second. But what we want to do next is a counterfactual exercise where we ask, what if these last 8 years had been different? What if there had been no changes and concerns about climate? What if there had been no cash flow news for green versus brown companies? To study that, we're going to compute counterfactual returns every month for the green factor. And we do that by just zeroing out, setting these regressors equal to zero and recomputing the return. And what I'm showing you here in red are those counterfactual returns on the green factor. For comparison, the blue line shows you the realized return. So what actually happened is that the green factor outperformed. But once you set those climate concern shocks to zero and those cash flow shocks to zero, the outperformance of the green factor, it completely vanishes. So what we're finding is that this these green assets would not have outperformed had there not been these big increases in concern about climate over the last 8 years. We want to go a step further, though, and ask, well, what if there had been no ESG flows over the past 8 years? In fact, we want to turn off these drivers of green returns one by one. And we do that in this picture. Starting with the realized return, this is what actually happened. The first thing we do is we turn off concerns about these increasing concerns about climate. We find that, well, returns would have been like this green line. So it's those climate concerns that are really doing most of the work. Without the climate concerns increasing, green would not have outperformed. Next, we also turn off the cash flow news, green versus brown. That doesn't do much. But then we additionally turn off the flows into ESG funds. And that actually does a lot of extra work. Now the line slopes down. So what we're finding is that without these unexpected shocks, green assets would have actually underperformed during this period. And this is that's consistent with a downward sloping line after we turn off things that were unanticipated. But if there were enough of these unanticipated shocks, that could lead green assets to outperform, but that outperformance was unexpected. There are a lot of other interesting results in the paper, but let me conclude with kind of the big picture. What we're finding in this project is that the realized returns exceeded the expected returns for green assets in the 2010s. And we're arguing it was largely due to these unanticipated increases in concerns about climate change. Why should you care about this? Who cares? Well, this result has 3 important implications. First implication is a very practical implication for ESG investors. And we're saying, look, bad news. You should not expect this really high outperformance we've seen for green assets to continue. So that's bad news for ESG investors. But then we have good news for ESG investors. It's also good news for the climate itself. The thing to remember here is that an asset's expected return is the asset's cost of capital. All right. So we have an implication about green firms' cost of capital relative to brown firms' cost of capital. A very naive person would look at the last 8 years and say, these green assets have had high returns on average. That means green firms have high cost of capital. That's exactly the wrong thing to conclude from the data, right? What we're saying is that green firms' cost of capital is actually a lot lower than their recent returns would suggest. And that should make you happy if you care about the climate, right? Because one thing that we're hoping about ESG investing is we're hoping ESG investing is reducing the cost of capital for clean firms, increasing the cost of capital for dirty firms. And our results in this paper suggest that is probably what's going on. And last, we have kind of a broader implication about how we should be doing empirical asset pricing. So in empirical asset pricing, it's very common to measure an asset's expected return using its average realized return. The point of our paper is that it can be very dangerous to measure expected returns with average realized returns, especially if you're only looking at returns over a fairly short period of time when there were lots of shocks. And basically what we're saying, these last 8 years had huge shocks related to climate change. And those shocks could lead a naive person to even get the sign wrong about the expected returns on green versus brown assets. And this really matters, for example, for people out there in the academic literature who are trying to do things like measure a risk premium for climate change. If you kind of don't appreciate this point we're making, you could get the sign wrong on a climate risk premium. And also, as I mentioned, we're finding that the green outperformance helps us understand this kind of very unusual and historic underperformance of value stocks. And I didn't have time to show you the details, but we're also finding that smaller stocks during this period underreacted to climate news, or at least they reacted with a delay to climate news. So this is when I should stop and take questions.
Thank you very much, Luke. Really interesting presentation. And yeah, let's open up the floor for questions from the audience, from participants. Feel free to unmute yourself and we can discuss a little bit the topic.
Hi, Luke, thanks a lot for this really interesting talk. So one question, so if I understand that right, the green outperformance seems to be mainly driven by unexpected increases in the demand for financial assets rather than for products. Did I get that right from your kind of very compared climate news versus earnings forecasts and ESG flows?
We wish we could make that claim. We think it's a bit premature. We've used so if it's coming from customer demand, it should show up in these measures of earnings news. We've measured earnings news in the best way we can think to do. And those measures don't seem to be the most important one, right? Which suggests that it's really the investor channel that's driving the results. The reason we're not quite comfortable making that conclusion is that it's notoriously difficult to measure cash flow news, right? We're not confident we've measured the customer channel perfectly yet. Yeah.
Thanks, interesting.
We would love ideas, by the way, that people have for how can we disentangle whether this was investors demanding green stocks or was this customers demanding green products. We'd love ideas. Better measures of customer demand or cash flow shocks or investor demand. Let me expand on that. It really matters, by the way, whether it's the customer channel or the investor channel. If it's the investor channel, mainly driving our results, if investors demand more green assets, that pushes down the expected return on green assets, whereas the customer channel has no effect on expected returns. So in other words, if green assets outperform because investors demand more of these assets, that spells really bad news for the forward-looking expected returns on green assets. But it also means there have been huge shifts in the cost of capital for green versus brown firms. And that's good news for the environment.
I'd maybe like to pick up on that prediction or that warning that you issue that maybe the returns on green assets may turn in the future. And people who have sort of maybe gotten used to that should prepare. What's the view on the timing of that happening? It might well be that concerns over climate change continue to unexpectedly increase for some time. So probably you're not, or what's your thinking there? I mean, could it just continue for another 10 years that way?
I wish I could answer your question because I would be able to make a lot of money off of it, right? We can't answer that. I don't think anyone can answer that question. It's by its nature, unexpected things are unexpected. They're hard to forecast.
Right.
Could green assets continue to outperform for the next 10 years? Yes, absolutely. We're basically saying green assets got lucky over the last 8 years in a kind of a sick way, right? Green assets could continue to get lucky over the next 10 years if concerns about climate increase more than is expected. The key part of that was more than is expected, right? Everyone here expects climate problems to continue, right? To the extent it's expected, it's already priced in today, having no effect on future returns. It would have to be that the concerns increase more than expected for green assets to continue to get lucky.
I have a question relating exactly to this. I was wondering whether this economic significance of the sensitivity of returns to climate concerns might change. So from typical factor theory, we know that, there's value momentum shifts. Could there also be a shift there? Could investors become immune to climate news shocks? Is that possible?
Yeah, that's kind of a cool question. It could, yeah. I'm also that's a question about the future. We don't have the future data yet, so we can't test it. But one thing we could test is whether that coefficient changed within our sample, right? We've only got 8 years of data, but we could split it into the first 4 years and the second 4 years. Did that coefficient change over the first versus second part of our sample? I'm kind of curious to know now. The other thing is that, it's possible that the coefficient won't change, but the amount of news will change, right? Our thinking is that stuff only shows up in the newspaper if it's news. Climate problems are going to continue, right? We're going to have extreme weather events and so on, but people may become kind of immune to those events. If they're immune to those events, then newspapers will stop covering those events because they're not news anymore. They were expected.
Can I ask something related again to this point? And I very much like this, what you just re-emphasized, what is expected in the change of the concerns and what is unexpected. Is there anything you can say about the quality of that news? So what exactly news or concerns? Are concerns specifically related to something related to the changing climate, or is something else? And maybe this is also somehow connected to what Anthony was asking. Am I getting immune to the fact that yet climate will become more severe and harsh, as opposed to might really affect my neighbors or my investments? Do you have a sense of that concerns data sets?
We're very curious about that as well. And it's something that is on our to-do list to look at. We're kind of interested in what is it about this news that's driving the performance? And we can potentially answer that because this index that we use, that created by Ardia et al., they also decompose their index into various components. And we're going to study which component of their index is driving our result. We would not be surprised if it's regulatory news driving the result. And there is a regulatory component of their index, and we have it. So we're going to see what happens with it.
Hi, Luke. I also have a question here regarding the difference between the investor demand for the asset and also in terms of the cash flow. Could it be also that if the investors they expect that more people caring about the environment, and then the cash flow of the firm is going to increase in the future, therefore, which means the firm value would increase, and then the price also increase in the end.
Let me make sure I've understood your question. So you're asking if people learn that the cash flows are going to be higher.
Yes.
Does that make the stock price go up?
Yeah.
So is that driving our result?
Yeah.
Did I understand correctly?
Right. So investors they demand more of the stocks, not just because they're more aware of the environment issue, but they can also interpret it as the future cash flow of the firm is going to increase, and then therefore the price is going to increase the price.
We think we can rule that out through one of our cash flow measures. So let's say people kind of learn over time that green firms are going to have higher profits in the future. Well, that's something we already measure in our paper. We have one of our cash flow news measures. Sorry, I went through it super fast. We're measuring analyst forecasts of companies' long-run earnings growth. So that's something we can measure. And that should be picking up these effects of investors learning about cash flows. So we already measure that. It is positively related to returns, but not very strongly, actually. So we think we can kind of rule that out. Now, you might say, look, you're not measuring it well enough. Maybe we're not measuring cash flow news well enough. You could certainly say that. There are problems with the earnings, analyst earnings forecast data, for example.
Right. Or also, I'm not sure to what extent the analyst forecast, earnings forecast will capture this this environmental factor.
Yeah, you'd have to make the case that these analysts are not very good at their jobs, which of course is possible.
Okay. Thanks for the explanation.
Yeah. And that's why I didn't want to take a strong stand. I think it was earlier on Florian's question, like, is it the investor channel or is it the customer channel? We're not comfortable saying it's the investor channel yet, because we're just not, it's notoriously difficult to measure things like learning about cash flows.
Right. Yeah. Thanks a lot.
Yeah. Thanks for the question.
Can I just have curiosity about the, I think it's the D parameter. Is it the propensity to prefer, is it a preference for green versus
Exactly.
brown? Do you have a sense of the evolution of D across time? Is actually D an alternative way of looking at the increment in the concerns?
Yeah, that's exactly our story. That's the investor channel.
All right.
What I've been calling the investor channel is D bar increased. That's all we're saying.
Okay.
People's taste for green assets increased, and that was unexpected. That's our story. Do we think D bar increased? Absolutely. I mean, that's certainly our intuition, right? The way we try to measure changes in D bar
exactly
is through ESG flows.
All right.
The huge flows that we've seen into ESG mutual funds, ESG ETFs.
Okay.
Yeah.
So you have a sense of this unexpected increase in D, that in theory, everyone would understand norms are changing, so D is increasing, but there might be a sense of unexpected increase in D. Okay, thanks.
Yeah, exactly. That's what we were trying to measure with those flows.
All right, thank you.
Can I maybe chip in with one question here, Luke? I was wondering about international evidence. Have you thought about looking at different countries and how this story plays out in different countries around the world? I'm thinking Europe now because I'm from Europe, but yeah, maybe also because the values there for environmental norms differ substantially. This might be useful in your setting.
Yeah, we could certainly look at it. We've already, in the MSCI data that's sitting on my machine, we have all the European companies in the data, so we could certainly look at it. We don't expect to find any difference, though, between the Europe and the US. And the reason is market integration, right? If we have a globally integrated financial system, there shouldn't be a difference in the timing of these returns. Now, you may still find that in the data. You may find that if the markets are segmented between the US and Europe, I would have expected, well, we know Europe woke up to the dangers of climate before the US. Europe was way ahead of us. So then I would have expected green assets to outperform in Europe like a decade before they outperformed in the US. But that would, again, this relies on a very strong form of market segmentation.
Which might probably not be the case. Yeah,
that's we doubt it's there in the data, but could be.
Yeah, thanks.
Yeah.
I think we are at the top of the hour. So thank you very much, Luke. I think it's time to wrap up. Maybe if you have closing words, feel free to say to the audience. And thank you very much, everyone, for participating. But we will continue discussing after we stop the recording. And yeah.
Yeah, I'll just finish by saying thank you again, Linda. Thank you again, everyone, for making time for this. And I've been busy typing up all your excellent suggestions.